I believe, yes, we're going through a shift. I believe we'll go from 55,000 agents to 20,000 agents in a matter of 18 months, right? And the reason it's going to take so long is because there are licenses that actually have to go through the process of expiring. Everybody, welcome back to the David Kurz Take Action podcast. We appreciate you tuning in. If this is the first time tuning in to us, please make sure that you subscribe to our podcast and that you participate in the stuff that we talk about. So feel free to downline it, answer things on the bottom. We'll make sure this video makes it to YouTube, Facebook, and everything else. So again, thanks for tuning in. If you want to learn more about me, go to davidkurz360.com. That's davidkurz360.com. You'll have access to every single social media platform or website that I'm participating in, and be great. You give me a follow, I'll give you a follow back. I want to introduce a few people that I have with me today because we're going to be talking about the market shift, which is interesting enough because this morning I spent an enormous amount of time preparing for and having a webinar online with just about 600 or so independent brokers around the country. And we did this webinar based on disruptions in the real estate market, but for the real estate agent. Disruptions such as Open Door and Zillow offers and Zillow referrals and things of that nature. So if you want more information on that, make sure to hit me up at davidkurz360.com. I'll make sure you get a copy of that video so you can take a look at it. But today we want to talk about market shifting, or this afternoon we're going to talk about market shifting and what's happening here in South Florida and what we know of the nation, what we know that's happening around the nation. So I've got some special guests with me. Again, my name is David Kurz. I'm the broker owner of Kurz Real Estate. I have Rudy Hernandez in the room with me today from New World Title. He's the president CEO. I have Anna Bozovic she's an analytics specialist. Can I call you that?
Sure.
Awesome.
All right.
And then Jeff Harris with North American Title Insurance and the state agency manager, right? Correct?
Yes, sir.
All right, awesome. So I want to get into it with you guys, and we started talking before we even got the podcast going, just talking about what's happening in the market today with let's talk about what we know. We're each in the industry some way, somehow, right? And we're seeing what's happening in the market today. We're seeing the slowdown in files. Like, what are you guys seeing out there in your prospective markets or prospective area in the market?
I'll start with that, Jeff Harris here. I can say unequivocally in the last 90 days we've seen a major shift which started in the middle of the summer from people just being overloaded with files all year to files starting to drip in, drip out, held through August, and then September people saw the results of that with a downturn in volume transactionally. And I think there was just something that was published last week that the largest amount of price reductions since 2010 was September of this year.
100%.
Right.
Yep.
And I mean,
Yep.
can we attribute a large amount of this to buyer? A word that I made up the other day, which is buyerability, right? The ability for a buyer to purchase, right? Can we attribute some of this? And I mean, I know the answer, but I want to hear you guys talk about it. Can we attribute some of this to the ability of the buyer to purchase with rising interest rates?
That's a good question. I mean, I would say the biggest impediment, I think one of them is that people don't feel scarcity. They don't feel pressure to buy. And that's a separate point to that because they see the same thing sitting in the market forever, and that's just reality. And you can't say it's not so. It is so. They see it.
Right.
And then it's hard to get people to pull the trigger because they don't feel that pressure. I think that's the first point. And the rising interest rates isn't helping. So I think it's both of those things going on at once. But the decrease in transaction volume has been going on since 2015.
Yeah.
So I don't think it's all because of the interest rates.
And I wouldn't say it's all,
Yeah.
but I think recently.
It's a factor because recently it's not helping. Like, it's like not what you want. There's already all this inventory and people are like dragging their feet, and then they also have interest rates going up.
So you've got inventory, you have less people
Yeah.
going under contract. Let's just call it that,
Yeah,
right?
exactly.
And it's actually getting much more expensive to borrow money
Correct.
now. Like
Yeah.
money costs more
It's
now.
become real now. It's
Yeah.
been trending out, but it's become real now. Like people are talking about it.
And unfortunately, it's our job to educate the consumer.
Yep.
Right? And so this morning when we were talking about how consumers consume, they consume the way they want to, right? Like less people are going to the store now because they have apps that'll deliver it to them, right? So less people are going to car dealerships because they have an app that will find the car for them and drop it off at their house in less than a week. Like that's what the world is moving to, but that's not what we're talking about here, right? We're talking, like you mentioned something very interesting. There's no rush. It's sitting on the market. It's going to be there tomorrow. No big deal. Once upon a time.
And that's across asset classes, not just residential. It's like,
right.
Yeah.
And once upon a time, there was a point in time where something was on the market and you were grabbing your client by the hair, like, hey, let's go. If we don't get our offer in, this will not be there.
That once upon a time was not too long ago.
It wasn't.
Correct.
And I
That's
wanted
right.
to punch on that for a little bit.
Yeah.
So how long ago was that? Like that was.
I would venture to say that
6 months.
Yeah.
probably the beginning of the year, we would see that happening and occurring on the often. There was a lot of competition.
And we saw even people battling on prices, right? Where you could price it at market value,
Sure.
and then somebody would come in 10 grand, 15 grand over because they wanted that house and they were tired of their offers getting
I
rejected.
think Jeff
at
was
full
spot
price.
on. The shift started occurring towards the very beginning of the summertime.
Right.
Agreed?
Yeah.
What else do you think you attribute this shift to?
So I think that we're also in a very precarious time right now because the market's already shifted. The prices have been overinflated because of the purchase price being too high. But now that interest rates are actually rising for the first time in essentially 7 years, I think that there is a little bit of buyers that are going to be priced out of the market because of rising interest rates.
Absolutely.
That they are jumping in and they'd rather pay a little bit more for the house knowing they can lock in for a 30-year fix
Right.
under 5%.
Right.
Because, it's not, my guesstimate is in 2 or 3 years, we won't see anything less than 7% interest rates, and it's not going to be that way for another 30.
And I honestly
We're
don't.
historically low. Yeah, exactly.
And I honestly don't think it's going to take that long. Like,
For the
it's
interest
been
rates?
so volatile right
Yeah.
now that we went from 4.5% to
Yeah.
5.5% like
Yeah.
this. Like there was a morning the other day. So we have an in-house lender, right? And he came to me to show me his market, I don't know, app reader, whatever it is that this company has. And he basically told me what I quoted out this morning is no longer valid, right? Because
I had that happen
based
to a
on-
client.
yes,
She
based
did a
on
quote
this
like the day
interest rate.
before, the next day it was actually different.
she was out.
Yeah.
Right? And so based on that, especially when we talk about buyers in the 250, 300, 350 price range, which is the majority of the buyers, if you think about it, right? We're talking about people who are very tight on that debt to income ratio.
that ratio.
You know?
About 10 years ago, I was told that if the interest rate increases by 1/8 of a point, 45,000 people that qualified yesterday don't qualify today.
That's insane.
Yeah.
So on Friday, I heard something very similar. It said for every, I think it was half a point the interest rate goes up, the qualification goes down by 15%. Right? So think
seems
about
about
that
accurate.
for a minute. That's, you qualify for a $200,000 house, now you're down to like 180, 175,
That puts downward pressure on everything.
Exactly. So, and I think that that's what's happening.
Yeah.
And I think sellers are going to have to, and again, it's our job to educate the community, right? It's our job to let them know because they're listening to Fox, CNN, and all the gloom and doom economists coming on there and telling everybody it's the end of the world as we know it, right? And so I don't believe that. I believe, yes, we're going through a shift. I believe we'll go from 55,000 agents to 20,000 agents in a matter of 18 months, right? And the reason it's going to take so long is because their licenses actually have to go through the process of expiring, but they're going to be out. They're going to be out of the game because they didn't develop what they needed to develop to stay in the game, right? So how do you stay in the game right now?
You got to forecast for what's coming and stay ahead of the curve. Be cognizant. I mean, if you look at, go shift for a second to the commercial sector, I think that we're going to see defaults that are going to be left and right in 3 to 4 years because if you've seen the amount of people that have been buying commercial product, at least in South Florida, that are buying at 3 and 4 and 5 caps, based on the fact that they're borrowing at 3%, and even the institutional investors that are borrowing at less than that, when that number shifts to 4 and 5%, they go from a 5 cap to a 0 cap to a negative cap, and with
You see
little
extreme
effort.
default there.
Yeah.
The debt cycle, totally.
Correct, and there's I've already heard from some of the foreclosure firms that I work with that they've already started seeing the next wave of foreclosures begin, and some of it's, believe it or not, even on a reverse mortgage world, which I don't think we've ever seen before.
Yeah.
But they're starting back in the foreclosure cycles. The foreclosure firms that have been dead for the last 3 or 4 years are just starting to see more action take
More
place.
action. Yeah.
Interesting. Well, I would also tell people that, on top of everything he said, to add value in some way, in some unique way. In a market that's tough, where there are fewer and fewer transactions, you can't just put pretty pictures of yourself up next to properties. You know what I mean? Like, you have to add value. People need
You
to.
mean it can't be a selfie world anymore?
Right, and that's when you
forward,
say it goes from X 40,000 agents to whatever it is. Like, you have to add value so that people choose to work with you, and it has to be real value in some way.
Let's say this, like, before we get to the value proposition of a real estate professional, like, you study analytics, right? For real estate, what are you seeing on trend?
In terms of what?
What's happening in South Florida?
All of South Florida? I mean,
Call it that. What?
okay, so I mean, the good that's happening in the state and all of South Florida is that people keep coming here. We keep growing in population, and that's a very positive long-term trend. And that's been longer than the price cycles. Price cycles go up and down every 10 years, whatever it is, but people keep coming here. So that's a very positive thing. We're not one of the states losing population. So that's great. Also, specifically in the Miami area, we have the job market's good. Office space is tight as a sector. That's one sector that's doing very well because not enough offices were built. People built condos and all those things, but not offices. So all those things are good. The average median salaries are going up. All that stuff is great. So those things are great. But what we're seeing down here specifically on residential is overbuilt of luxury, just like everywhere else in the country, but perhaps more so here. And then also just going back to what we're saying, it's just in addition to that overbuilding of luxury, it's just all this stuff is just symptomatic of being late in the credit cycle. It's just what it is. It's just the credit cycle. So we have a record long bull market. We have yield curves flattening. We have interest rates going up. All that stuff is going to play out, and that's bigger than this market. So
a lot of people are worried about a gloom and doom.
No, I don't think so. It's going to the positive people.
What do you see is happening in the next 18 months? Let's call it that, because it's going to shift fast. Like over the next 2 or 3 months, we're going to see shift. Q1, Q2, we're going to see massive difference. Where do you see us Q3, Q4, 19?
So the good news is I don't think that we'll be anywhere near where we were in the last cycle shift, where there was no activity for 18 to 24 months. The good news is South Florida, really in the last 10, 12 years during the recovery, was so much cash infused. Mm-hmm. But what I do think we'll see is, for sure, price correction. I think that whether it's in 2019 or 2020, we'll have some kind of recession. It's not going to be at the same level that we had 12 years. Right.
No.
But every 12 years it happens. Yeah. And that's time. And price, stock market's at all-time highs, real estate's at all-time highs, interest rates were at all-time lows, now they're shifting up. It's all going to correct. And it's all going to correct together. And as the stock market, it was just so volatile last week, I think it breeds uncertainty in the market.
Yeah.
So, but the good news is there's so much cash in South Florida. I think you take a lot of the South American investors that were parking their money here buying condos. If you're somebody from Brazil that bought a $500,000 condo for cash 10 years ago to get your money out of your country safely, but now you're back in your country and you want to get your money out because the American dollar is so much stronger than Brazil's.
Right.
Even if they sold their condo at a 20% loss for $400,000, they've got more money.
They're winning left and right.
Yeah.
So I think that the correction is going to be, when you see rent prices and purchase prices, kind of the cost of having both, being even, then I think that the market will be healthier. But right now, you could rent an apartment for $500,000 that you'd have to pay 1 to 1.2 to buy.
Yeah.
So why would you ever buy it?
Yeah. No, I think this is a healthy thing when it corrects that way also, because when the prices get out of whack with rentals and with what people who work in the city can pay, then it creates all these pressures. So we were seeing condos now in Brickell that are below 2011 prices.
Yeah.
Like $290 a square foot.
And that's great. I mean, look, at the end of the day, so one thing that I want the people listening or watching or to pull away from this is no one has said we're headed towards a crash. As a matter of fact, Jeff, you said the best thing, which is we're headed into correction, right? Yeah. So, let's just be mind blown for a second. We're actually going to go into a normalized market.
Which is good. It's fine.
Which is fine.
Right? It's okay.
I think, and if I can interject for a second, I think the biggest thing that needs to be relayed here is that there is a shift. The problem that we're seeing, or at least I'm experiencing with a lot of the agents that we work with, is that they're oblivious. to any of this even
Right,
happen.
which is why we're doing this right now.
That's
Because
exact.
Jesus Christ.
So as far as I know you use the words gloom and doom.
And I'm Jewish.
You're Jesus Christ. I think you're the only one using that word for now. I don't. But I commend
But I've
you.
heard people talk it.
But I've
Some
heard
people are,
people
yeah.
talk it, and I'm like, hey, listen, correct yourself, because if you just run around town screaming gloom and doom, that's what's going to be
Yeah.
picked up.
Sure.
It's very
Yeah.
rare that positivity gets picked up.
It doesn't
right?
sell. People
So
like
right.
that kind of
So I appreciate the forum and the platform because he's absolutely right. The word you can use is correction, and I think that there has to be value proposition that's placed on to our agents and brokers, and so that there is some sort of sustainability. But there's no gloom and doom. I think that whoever's screaming that is
Well,
probably
and the
not
last
saying
time, so
right.
it can't have that same precipitous drop because last time everything crashed across all price points because it was all fueled by those like ninja
Right,
loans, like
right,
liar loans, the
right.
whole market, and so there was no floor, and the whole thing crashed.
And I'm glad you brought
And-
that up, because don't be surprised when the new stuff starts coming out right
Oh,
now,
yeah,
right? Because we're
yeah.
headed into a normalized market. So how do we keep sending money? How do we keep lending money? We create new programs,
Yeah,
right?
of course.
So right now, like even right now,
They just started the
programs are
ninjas again, right?
5% down for a $2.5 million house, as long as your credit's over 720.
I've seen that.
5%
I know.
down,
Right.
no PMI, none of that stuff. 5% down a $2 million house. What is that person's monthly nut, right? And
Yeah.
then is that sustainable? So we talk about that foreclosure market pulling in.
Right.
Right.
Absolutely. Right. And you see those programs happening now when everybody else thinks it's the healthiest time of the market. Prices are great, interest rates are low, or prices are high. Why would they need to give a 5% loan? And I've even heard lower on the lower tier
I've
properties.
seen really
Right.
low percentage.
Yeah. So.
No, and I get emails all the time now, 100% financing.
Yeah.
Right? We're back to that again.
Yeah.
Right.
Yeah.
You know?
Where I do think that the major correction is going to be the investors that have been, I believe, aiding the marketplace for the last 5, 6, 7 years, where they could take opportunistic properties, put value and renovate properties and make a healthy spread. I think their spreads have been shrunken so much as the market's
Absolutely.
declining that
Absolutely.
I think that that's the biggest part of the market that's going to take the hit first.
Oh, yeah.
I think it's already taken a hit.
Yeah.
Yeah, it has.
Yeah.
Sure.
It has, for
Yeah.
sure. For sure. All right, I'm going to close it out with a final statement. Does anybody have anything else they'd like to add to the listeners?
Well, I just want to go back to the topic of gloom and doom is that the problems of the market this time aren't systemic, they're not across the board, so to end on a positive note there, Miami's a growing city, the whole region's growing, and so the residential properties that are within price point that people who have jobs here are actually not an oversupplying crisis. It may be more difficult to buy, there might be some downward pressure because of interest rates, but there's no glut of supply of price attainable housing, which is so there's a floor. The whole thing can't crash like last time. That as you go higher in price, that's where the problems are. So if people are focusing on properties that people with families can purchase, who live and work here, that segment of the market is not in crazy oversupply at all.
Right.
Yeah.
Right, and there's actually might even be a little bit of a lack of
Undersupply.
supply.
Correct.
There's an undersupply
Correct.
where it comes
Yeah.
to someone who lives here who needs a family
Correct.
home.
Exactly.
And look, what I would tell most people walking away from this is that we're not headed towards a crash. We are headed towards a correction. And as Jeff said it best, forecast it, right? Don't play defense the entire time, man. Forecast it, know where you need to be 6 months from now, 12 months from now, 18 months from now, so that you can take advantage of every situation that comes your way. Because even this morning, talking about the disruptors, right? There's a way to take advantage of every one of those disruptions as a real estate agent.
Yeah.
The problem is, like Rudy said, no one here knows it. And our market is famous for being oblivious to what's happening in the rest of the country. It's really true. You know what I mean? And very few times does anyone in this market, out of the 55,000 agents that we have, really take the time to do what everyone in this room does, which is study the market locally, analyze what's happening here in South Florida, and then analyze the nation, because whatever's happening in the nation, it will end up here at some point, sometime. San Diego's gonna get it too. It just might take longer. You know, and I just think those are the major differences that is with our market and other markets. We're so accustomed to people just being oblivious, and so I hope that this podcast gets in front of as many people as possible in today's market right here in South Florida, so that they get a true understanding of where we're going right now. And I mean, look, I appreciate the three of you coming, some of the brilliant minds in the industry, and I'm privileged to have you guys on the show with me, because this is an opportunity for someone to sit in their car on the way home and begin to learn how to forecast moving forward, right? So I want to say a couple things. First of all, thank you again for following us, and make sure you subscribe to this podcast because we come to you at least once a week with new information. And one thing that I want to point out and understand, look, FSBOs are at a 30-year low. It's a for sale by owner for those of you agents out there that don't know what that is. FSBOs are at a 30-year low nationally, right? What does that mean? That means that for sale by owners are starting to truly understand that real estate professionals will get them more money. Focus on that, understand that, learn where the numbers are so you know where to focus, right? Because the gap between what a FSBO sells their home for and what an agent sells their home for has increased tremendously, okay? So nationally, I believe with an agent, it's around 237, FSBOs by themselves are 190, right? That's a huge gap. So as a real estate professional, know how to speak to your sellers and help them understand that even with paying you 6% commission, which by the way, that's changing in the market as well. It's called commission compression, right? And we're gonna start seeing more and more 5% commissions happening hitting the market. And that's something that we're going to have to adjust to. Why is that happening? Because there are massive changes happening where sellers have more options. Like they can list their property by themselves on a massive platform like Open Door and receive offers right away. And they think that because they pay you 6%, it'll be cheaper through Open Door, when the truth is that if anybody just takes a few minutes to study, the average Open Door cost is 7.6% in fees, and they go as high as 16%, and their offers are typically 15 to 20% below market value. So on top of getting an offer 15 to 20% below market value, you'll pay on average a 7.6% fees, not commission, but fees to this company. So help yourself by helping your clients. We're sitting here trying to educate you and make sure that you, as a real estate professional, understand what's happening in the market. Take a moment to truly understand the market and educate the consumer. Once you educate the consumer, they will be more than likely to work with you because you were the one that educated them. Understand how consumers are actually consuming and understand that you will have to make the shift to that. Thanks everybody for tuning in. Again, you can hit up my website, davidkurz360.com. That's David, Kurz 360.com. Subscribe to the podcast. Don't forget, these guys are gonna share because I'm gonna force them to. And thanks for tuning in. Talk to you guys soon. Thank you guys for being on the show with me.
Thank you very much, Hernandez.
Sweet. Good deal, man. Thank you.
Awesome. You're welcome.
Thank you.
I thought it was like 2 hours long, so I was like,
My coffee, my water.
No, I mean I actually try to keep podcasts down to like 10 to 15 minutes. So
Yes,
this
people
one went a
like
little
it
bit
to-
overboard. Yeah, I
Did it
think
really?
we were at
About 25
Wow.
minutes.
yeah.
Oh, wow.